Fed Chair Jay Powell's focus on disinflation means we're unlikely to see a straight line back to that 2% target. Joining us now with why is Laura Cooper, BlackRock Senior Macro Strategist for iShares EMEA. Thank you for joining me this morning, Laura. So talk about this path that we could be on. I mean, we heard from Cleveland Fed President Loretta Mester this morning saying she would have favored a 50 basis point hike earlier this month.
Well, it's interesting in the sense that when we talk about whether this is going to be a soft landing or a hard landing or this no landing situations, it really does all come down to the inflation profile. So markets are certainly expecting that we are going to see this acceleration in disinflation. They're really extrapolating the trend that we have seen more recently. But we are actually seeing in the economic data, the fact that consumer spending remains exceptionally strong in the US does suggest that actually the inflation risks are tilted to the upside. So it could be a case where, yes, inflation at the headline level can go from those high single digits down to that 4 to 5% mark, but really getting back to those 2% targets is likely to going to be proved quite challenging. So we do expect this is going to be kind of the dominant theme going forward. Do we need an economic recession to really fight these inflationary pressures?
And we know that markets were clearly hanging on to hope to kick off the year as we saw that rally. It does seem to be now sinking in for them that the Fed is going to be doing more for longer to get to this 2% target. How would you describe market sentiment at the moment?
Well, it's actually been really interesting in the sense that we did have this disconnect earlier this year between Fed commentary suggesting that they do have more work to do versus what rates markets were telling us, in that the Fed was actually poised to ease in the second half of the year. So we've started to see rates markets catch up to that Fed commentary. And I think the price action that we're seeing today in equities with the drawdowns coming through is really equities maybe perhaps starting to catch on to that narrative as well, that if we do see this robust economic growth in the US, inflation continues to be sticky, notably that core services ex-shelter component, that does suggest the Fed may actually have to tighten even beyond what current market pricing is around that 5.25% mark. And I think that's why we're starting to see some of this speculative fervor in equities start to come off the boil.
So then what's your base case for rate hikes compared to what the market seems to be anticipating?
Well, if anything, we're more in line with what markets are expecting now. So we do see a terminal Fed pricing around that 5.25% mark. Now, after the exceptional payrolls report that we saw a couple of weeks ago, certainly with CPI continuing to remain sticky, and as well, yesterday's retail sales blowout does suggest that we could actually be poised for not just 2 more 25 basis point rate hikes, but it does raise the possibility that June or July could actually be live meetings, whereas markets are now pricing that pause coming through. So I think at this point, we're really expecting the risks tilted to the upside. Where the disconnect lies between market pricing and our base case is that the Fed has stated that they want to keep rates in restrictive territory through the end of the year. We've started to see markets price out the easing that they had earlier, but there is the risk we could see even more of that mispricing come out. So that's really the key factor that we're watching. Less about the terminal rate, but when that easing cycle will start to commence.
And we know that a lot of the sort of COVID-related supply disruptions working their way through the system at the moment. But you also note 3 long-term challenges that people might not be paying as much attention to that they should.
Yeah, and this is really underpinning the view that we do see this as a new macro regime, one marked by higher inflationary pressures. So we do think that we are going to see kind of the cyclical forces feed through into terms of the inflationary backdrop. We're starting to see that come through in terms of the disinflation in goods, and that's coming off the back of the supply chain easing, as you mentioned. We also saw the very strong dollar that last year that really made imports cheaper in the US. But this is really a regime that's going to be marked, for example, by geopolitical fragmentation that is more elevated than what we have seen over the past couple of decades. We do think that this transition to net zero and the need for businesses to really change their operating models is going to also be a series of supply side shocks that are going to be inflationary. And then there's this talk about aging demographics and the fact that when we look at labor force participation, a really interesting dynamic has emerged post-COVID. And that's the fact that a lot of workers have left the labor force. And in our view, they're unlikely to return. So we're going to see this continued supply demand pressures that are going to keep wages elevated. So ultimately, all of those factors suggest that structurally inflation is going to be higher. And that does kind of overlay the fact that we do think central banks will have to pause before they're actually able to get inflation sustainably back to those 2% targets.
Certainly a lot of volatility still ahead, and we've even seen that reflected in the VIX. They're heading inching closer and closer towards 20 today as well. Laura Cooper, thank you so much. BlackRock Senior Macro Strategist for iShares EMEA. Thank you so much.